Hello everyone. This is Fixed Income Market Outlook for the month of October. Last month, rates in India drifted downwards. The 5 to 10 year segment of the sovereign yield curve has seen 10 basis point rally, while the longer end of the curve has seen 5 basis point downward movement. This move is a result of FPI inflows, softer inflation, weaker high frequency data, and increasing expectation of rate cuts by RBI. It's rare to see incoming data, market expectations, and policymakers all in confluence. The dominant narrative right now is that RBI is eschewing any revision in growth inflation forecast, as we have seen in the recent monetary policy outcome. It is a change in stance neutral, which is right now seen as a precursor to rate cuts in future. We view this as an attempt by policymakers to balance the risk emanating from higher food inflation, the still evolving interest rate cycle in the US, and heightened geopolitical risk. In US, however, the data somewhat has deviated from the expectations of market and Fed's forecast. Strong payroll data, consecutive strong core CPI readings are good for growth picture, but it raises question as if we are returning to the higher for longer rate narrative again. This employment data has led to sharp repricing of expected rate cuts as indicated by the implied policy rates in US. One big difference this time is that negative surprises on inflation has not led any significant repricing, unlike earlier times, as market views these spikes as temporary and views overall inflation slowly moving in the right direction. In nutshell, this has resulted in bear flattening even after 50 bips rate cut last month. The monetary policy in India is at inflection point. The change in stance by RBI is in line with expectation that barring the spike in next couple of months, the inflation is expected to be subdued in coming quarters, and to an extent that the high frequency growth data is slowing. The growth forecast by RBI is still not revised downwards, but this change in stance has created space for RBI to cut the rates in next few policies, while it still gives space to RBI to maintain the optionality as geopolitical risks remain elevated. The other risk in domestic macros is in the form of volatile food inflation that we can see easing with better agriculture output ahead, as indicated by the surplus rain this season. The Fed's 50 basis cut last month has widened the rate differential in India. Additional 50 basis point cut expected this year will create even more headroom. This should ease any concerns about lower rates encouraging capital outflows from the country. Overall, we see the reasons for the rate cuts are stacking up. IGBs have done relatively well in last year due to favorable demand-supply dynamics. Fiscal consolidation and FPI inflows have meant that benchmark curve has outperformed corporate bond curve. The AAA PSU corporate bond yields have followed up, but are still lagging benchmark curve. We are in a zone where historical probability indicates the relative yield spreads are in a sweet spot. Investing in short to medium duration PSU corporate bonds right now may benefit from the drop in yields, as we expect a shallow rate cut cycle, and in addition, possibly by mean reversion of spreads. Even if yield spreads widen to historical max, the relative yield spread at a time of entry now may offset this and result in a break-even vis-a-vis GSEC of same maturity. Thank you.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.